Welcome to our deep dive, into Samvardhana Motherson International Limited,
Mm-hmm.
SAML, the global auto parts giant.
Huge company.
We're going to unpack their second quarter results for fiscal year 2024-2025.
Okay.
Hot off the press, November 12th. We've got both their official press release and investor presentation.
Oh, nice.
It's like getting a sneak peek into their boardroom, seeing the raw numbers, Andy, how they want to spin the story.
Right. So it's interesting here. What's fascinating is that they're posting impressive gains in kind of a tough global environment right now.
Yeah.
Auto production is sluggish, commodity prices are up, yet SAML is defying expectations.
Okay, let's unpack this. Their consolidated revenue jumped a hefty 18% year-on-year, hitting a cool euro 27,812 crores.
Wow.
But we need to look beyond the headline number.
Absolutely. Part of that jump comes from acquisitions they made during this quarter.
Right.
But even when you factor that out, their organic growth, meaning their existing business, is still clocking in at a solid 4 or 5% above the overall market trend. They're not just riding the wave, they're paddling ahead of it.
So they're outperforming the industry. What's the secret sauce here?
Their investor presentation highlights diversification as a key driver.
Okay.
They're introducing new products and forging deeper relationships with key customers.
Okay.
It's a classic risk mitigation strategy, not putting all their eggs in one basket.
Smart move. Spreading the love, so to speak. What else are they doing?
They're laser focused on operational efficiency. Think of it like this. They're finding ways to squeeze more profit out of every rupee, even with those external factors working against them.
It's like making a gourmet meal with budget ingredients.
Exactly.
Now let's talk about their move into the aerospace sector.
Okay.
They acquired AD Industries Group, right?
They did.
What's the play there?
This acquisition signals a bold strategic shift. They're looking beyond the automotive world, expanding their horizons into a sector with a lot of growth potential.
It's a daring move considering the aerospace industry is in its own state of flux. So what's the big picture? Are they playing it safe by diversifying and getting lean? Or is SAML setting the stage for something even bigger?
Their focus on deleveraging their balance sheet, specifically bringing that debt-to-equity ratio down to 1.0x, is a fascinating clue. It suggests they're either being cautious in uncertain times or clearing the decks for a major play down the line. They're either battening down the hatches or loading the cannons. Which one is it?
Intriguing. And they're doing all of this while still turning a tidy profit. The investor presentation talks about normalized EBITDA.
Right.
What's the significance of that?
They're stripping out a one-time gain of over 178 crores from acquiring a controlling interest in their joint venture Motherson Auto Solutions Limited.
Okay.
It's like saying, look at our underlying performance even without this exceptional event.
So it's about showing their true earning power.
Yeah.
And they're flexing some serious muscle here. Their normalized EBITDA is up 23% year-on-year.
That jump in EBIT is particularly impressive, given the industry's challenges.
Yeah.
It really underscores their focus on operational excellence and cost control. They're squeezing more profit out of each unit.
Okay, so revenue's up, EBITDA's up. What about the bottom line? What's happening to their actual profit?
Their normalized profit after tax attributable to the company's owners.
Yeah.
It shot up a remarkable 66% year-on-year.
Oh.
They're definitely not playing around.
That's a serious leap. But what does it actually tell us about SAML's overall health and strategy?
That's where the ROCE comes in, their return on capital employed.
Okay.
It's a measure of how effectively they're using their capital.
ROC, a classic indicator of financial health.
Yep.
What's the story there?
Even with sluggish auto production and the resulting increase in working capital, their ROCE climbed to 17.3% in September, up from 16.9% in March. They're generating more returns from their investments despite the challenges.
So they're getting more bang for their buck, which is always a good sign.
Precisely. And it paints a very positive picture of their operational efficiency, especially in the context of those challenging market conditions.
All right, so far so good. Strong financials, strategic acquisitions, and a laser-sharp focus on efficiency. But what about those macroeconomic headwinds? The investor presentation hints at some mixed signals in the global economy.
Yes. While inflation and interest rates seem to have stabilized commodity and energy prices are creeping upwards.
Right.
And then there's the persistent uncertainty surrounding global supply chains, thanks to various geopolitical tensions around the world.
And let's not forget about the sluggish auto production they're contending with. Their presentation shows a decline in global light vehicle production.
It's worth noting, though, that while overall production is down, the mix of platforms is evolving.
You're talking about the shift towards electric vehicles.
Exactly. While some markets are seeing slower than anticipated EV demand, it's still a major force reshaping the automotive landscape.
And SMIL seems to be placing a substantial bet on that electric future.
Yeah.
Their booked business, a measure of future orders and a strong signal of confidence from their customers, has a significant EV share.
Absolutely. This speaks volumes about their long-term vision. They're not just reacting to current market conditions, they're actively positioning themselves for the automotive landscape of tomorrow.
So we're seeing a company demonstrating resilience in the face of challenges and a forward-looking strategy.
Yeah.
How are they managing this balancing act in such a complex and volatile environment?
Their presentation highlights several key elements.
Okay.
First, their diversified business model designed to cushion the blow from regional fluctuations in vehicle production.
That's their 3CX10 strategy, right?
Yep.
No more than 30% of revenue from any one component customer or country.
That's it.
They're spreading the risk.
Precisely. It's a strategic buffer against any single point of failure.
Smart. What else is contributing to their resilience?
Their product portfolio is almost entirely powertrain agnostic.
Yep.
This means they're supplying components in demand, whether it's internal combustion engines, hybrids, or full-blown EVs.
Got it.
They're not picking a side in the powertrain debate. They're supplying them all.
So they're riding the wave of change rather than being swept away by it.
Exactly.
What other factors are at play here?
Strong customer relationships are vital.
Okay.
They emphasize pain sharing, working collaboratively with their clients to navigate challenges together. It's about fostering a sense of partnership, not a transactional zero-sum game.
Okay, so they're diversifying, staying flexible, and building strong partnerships. But what about that deleveraged balance sheet? How does that fit into the bigger picture?
That's a crucial piece of the puzzle.
Okay.
Having a strong balance sheet gives them the financial firepower to seize growth opportunities as they arise. They're not just weathering the storm, they're poised to capitalize on it when the clouds part.
It's like they're building an ark while simultaneously scouting for prime real estate after the flood.
That's one way to put it.
Yeah.
And speaking of seizing opportunities, let's take a closer look at those acquisitions they made this quarter.
All right, beyond the AD Industries group, which brings them into the aerospace sector, they also completed the acquisition of the Lumen Group. Fill us in on that.
Lumen manufactures and supplies OEM-certified automotive parts and accessories, specializing in wiring harnesses, which are crucial components for electric vehicles.
So this strengthens their core automotive business while adding geographic diversity.
Yes.
Their reach extends to key markets like Australia, North America, Thailand, Poland, and South Africa.
Exactly. It's a strategic expansion that broadens their market reach and deepens their capabilities in a vital area for EV production.
They also acquired a controlling interest in Motherson Auto Solutions Limited by purchasing an additional 34% stake from Sojitz Corporation.
Consolidating their hold on existing ventures.
Okay.
A logical move to streamline operations and maximize returns. And it's worth noting that all of these acquisitions haven't put a strain on their balance sheet. They've managed to expand while simultaneously deleveraging.
It's like they're juggling chainsaws while walking a tightrope, and somehow they're making it look effortless. Now let's talk about their booked business. The investor presentation highlights a staggering figure of US $87.7 billion.
Wow.
That's a lot of business.
It is, and it's a testament to their strong position in the global automotive market. This booked business represents future orders, a pipeline of revenue stretching years ahead.
Right.
It's a powerful signal of confidence from their customers, especially in such a volatile environment.
That's got to give investors some serious peace of mind. But there's another figure that jumps out, 24%. That's the share of electric vehicles in their booked business.
That's right. SMIL isn't just dipping their toes in the EV market, they're diving headfirst.
Oh.
They're betting big that electric vehicles are the future, and they're positioning themselves to be a major player in that space.
This recalibrated CapEx could signal a strategic shift. Are they prioritizing certain projects over others? Maybe they're seeing even bigger opportunities on the horizon and holding back resources for those?
It's possible they've reduced their CapEx guidance to 5,000 crores, plus or minus 5%.
Okay.
Despite bringing those newly acquired businesses into the fold.
Yeah.
This suggests a degree of caution. They're recognizing that the global economic environment remains uncertain and prioritizing financial stability while maintaining disciplined spending.
A prudent move in these volatile times. What other challenges are they highlighting?
They're grappling with the evolving strategies of their customers as the industry shifts towards clean mobility.
Okay.
It's not just about supplying components anymore. It's about anticipating and adapting to the changing needs of their clients.
It's like they're dancing with a moving target, constantly adjusting their steps to stay in sync.
That's a good way to put it.
What other hurdles are they facing?
Well, they acknowledge the ongoing geopolitical challenges impacting supply chains.
Right.
It's a headache for businesses around the world, and SAML is no exception. They're navigating a complex web of global tensions and disruptions, which adds another layer of complexity to their operations.
Now, their investor presentation mentions some of the near to midterm variables impacting the automotive industry.
Yeah.
Let's unpack those a bit further.
One major variable is the regional fluctuations in vehicle production.
Okay.
Some markets like China are experiencing a deceleration in EV growth,
Interesting.
while others are grappling with delayed new vehicle launches and adjustments to emission standards. This unevenness creates a lot of uncertainty for suppliers like SAML.
It's like trying to predict the weather across multiple continents at the same time. Quite a challenge.
Indeed. Another variable is the evolving customer strategies for the shift to clean mobility. Different automakers are approaching electrification at different speeds, and with different approaches requiring suppliers to be incredibly flexible and adaptable.
Right.
It's not just about making parts for EVs, it's about understanding the unique needs of each client as they navigate this transition.
And of course, there are the ongoing geopolitical challenges impacting supply chains.
Right.
The global landscape is anything but stable right now, which can significantly disrupt the flow of materials and components.
Absolutely. And finally, there's the ever-present volatility in commodity and energy prices.
Yeah.
Major input costs for a manufacturing company like SAML.
So they've got their work cut out for them navigating this complex and ever-changing landscape.
They do.
But how do they plan to address these challenges and maintain their impressive momentum?
Their investor presentation outlines several key strategies.
Okay.
First and foremost, they're leveraging their highly diversified business model, that 3CX10 strategy we discussed earlier, to mitigate the risks associated with regional volatility.
Right.
They're spreading the risk, ensuring they're not overly dependent on any one market or customer.
That makes sense.
Yeah.
What else is in their strategic playbook?
They're further bolstering their resilience with a product portfolio that's almost entirely powertrain agnostic. Whether the future is dominated by internal combustion engines, hybrids, or electric vehicles, SAML is prepared to supply the necessary components. They're hedging their bets, ensuring they're relevant no matter which powertrain technology wins out in the long run.
Smart move. Any other key strategies we should know about?
They're doubling down on maintaining strong customer relationships.
Yeah.
Their emphasis on pain sharing and collaboration helps to build trust and ensures they're working together to navigate challenges.
Right.
It's about fostering a genuine partnership where everyone wins.
And of course, their deleveraged balance sheet provides a critical foundation for both stability and future growth.
Absolutely.
It's like having a financial safety net while also having the flexibility to pounce on new opportunities as they arise.
Exactly. It's a powerful combination that gives them a significant advantage in these uncertain times.
All right, we've covered a lot of ground here. They're navigating a complex and challenging environment, but their strong financials, strategic acquisitions, and commitment to operational efficiency are impressive.
Yeah.
And their focus on diversification, flexibility, and strong customer relationships, all underpinned by a healthy balance sheet, positions them well for whatever the future holds. But let's not forget that they're making significant bets on the electric vehicle revolution. What does that reveal about their long-term vision and the future of the automotive industry?
That's a great question, and one we'll delve into even deeper in the next part of our deep dive. Stay tuned. Welcome back to our deep dive into Samvardhana Motherson International Limited. Before we jumped into the break, we were discussing SAML's commitment to electric vehicles and how that commitment is shaping their future. If we look at their recent acquisitions, there's a clear pattern emerging.
Let's break down that pattern. What are we seeing here?
Well, their acquisition of the Lumen Group, which specializes in wiring harnesses, aligns perfectly with the rising demand for sophisticated electrical systems in electric vehicles. They're beefing up their capabilities in a key area for EV production.
It's like they're stocking their toolbox with the right tools for the job.
Exactly. And their move into the aerospace sector through the acquisition of AD Industries Group is particularly interesting. The aerospace industry is increasingly exploring electric propulsion systems, especially for smaller aircraft and drones.
So that acquisition could give them a foothold in another industry undergoing a major electrification shift. They're not putting all their eggs in one basket.
Precisely. It's a strategic move that positions them to capitalize on the growing convergence of technologies between the automotive and aerospace sectors. They're looking beyond the horizon and anticipating the future.
Their investor presentation mentions that 5 out of their 19 greenfields have come on stream. For those unfamiliar with the term, what exactly is a greenfield project in this context?
Think of a greenfield project as building a brand new production facility from scratch. They're not acquiring existing factories, they're starting fresh with a clean slate.
So it's not about buying the horse, it's about building the stable.
That's a great analogy. And the fact that 5 of these greenfield projects have become operational is significant. It indicates that SMIL is actively expanding its production capacity, anticipating that growth in demand, especially for EV components.
And they're not stopping there. They expect 8 more greenfields to come online in the second half of fiscal year 2025.
That's right. It's a bold move considering the global economic uncertainty, but they're demonstrating a high level of confidence in their long-term prospects. They're aggressively investing in future growth, and they're not afraid to take risks.
It's clear they believe in where this industry is heading. Now let's talk about their financial performance. Their consolidated revenue for the first half of fiscal year 2025 is up 23% year-on-year, hitting 56,680 crores.
And once again, while acquisitions contribute to that growth, their organic business is also performing well, outpacing the market trend. They're firing on all cylinders here.
So they're demonstrating both inorganic growth through acquisitions and organic growth through operational excellence.
Yeah.
A powerful combination in any economic climate.
Exactly. And it shows they're not just buying growth, they're cultivating it from within.
Now, what about their profitability? Their consolidated normalized EBITDA for the first half is up an impressive 33% year-on-year, reaching 5,248 crores. What's driving this profit surge?
It's a testament to their relentless focus on efficiency and cost management. They're proving that it's possible to grow both revenue and profitability even in the face of external headwinds.
They're defying gravity, it seems. So revenue is up, EBITDA is up. What about their actual profit? What's happening to the bottom line?
Their consolidated normalized profit after tax, attributable to owners for the first half of fiscal year 2025, is up a stunning 66% year-on-year, reaching 1,741 crores.
That's a mind-boggling leap. They're
What?
clearly doing something right. Now, their investor presentation talks about the concept of pain sharing. Can you explain what that means in this context? It sounds a bit ominous.
Pain sharing isn't as scary as it sounds. It refers to the collaborative approach SMIL takes with its customers, especially when facing tough market conditions. It's about open communication, joint problem solving, and a willingness to adjust contracts and pricing to ensure both parties can weather the storm.
So it's not about one party squeezing the other. It's about working together to find solutions where everyone benefits. A rising tide lifts all boats, as they say.
Precisely. And this collaborative approach is a key element of SMIL's strategy. They recognize that their success is intertwined with the success of their clients. It's a long-term perspective that prioritizes building strong, lasting relationships built on trust and mutual benefit.
It makes sense. In a volatile industry, strong partnerships can be invaluable.
Absolutely. And it's a strategy that's clearly paying off. Their impressive financial performance and substantial booked business are a testament to the trust they've earned from their customers.
All right, so they're growing, they're profitable, they're collaborating with their clients, and they're making strategic acquisitions that position them for future growth in both the automotive and aerospace sectors. But they're not resting on their laurels. They're actively addressing challenges, recalibrating their CapEx plans, and navigating the complexities of the global economic environment. They're not just surviving, they're thriving.
They're a company in motion, constantly adapting and evolving to stay ahead of the curve. And that's what makes them so fascinating to observe. They're not afraid to embrace change and take calculated risks.
Speaking of calculated risks, let's not forget about that recent fundraising effort. They raised a cool issue 6,438 crores via a qualified institutional placement, or QIP. That's a significant injection of capital.
It is, and it demonstrates the confidence investors have in SMIL's growth strategy and their ability to execute on it.
Okay, but break it down for me. What exactly is a QIP, and why is it such a positive signal?
Think of a QIP as a way for a listed company to raise capital quickly and efficiently by issuing equity shares to qualified institutional buyers. These are typically large financial institutions with the expertise and resources to evaluate complex investments. It's a vote of confidence from those who know the market best.
So it's not just about the money. It's about the endorsement from savvy investors.
Exactly. And the fact that SMIL was able to raise such a substantial sum through a QIP speaks volumes about their credibility and the attractiveness of their growth story.
And they accomplished this by issuing both equity shares and compulsorily convertible debentures or CCDs. Can you explain how that works?
CCDs are debt instruments that magically transform into equity shares at a predetermined future date. It's a clever way for companies to raise capital while providing investors with the potential for equity upside. It's a win-win scenario.
So SAML gets the capital they need to fuel growth, and investors get a piece of the pie with potential for future gains. Everybody wins. But the big question is, what are they planning to do with all of this newly raised capital?
Their investor presentation highlights two primary uses. First, they're using a portion of the proceeds to repay existing debt, further strengthening their balance sheet. This is a prudent move that reduces their debt burden, gives them more financial flexibility, and lowers their interest expenses.
It's like cleaning up your financial house before throwing a big party.
Exactly. And the remaining funds are earmarked for general corporate purposes, which could include anything from investments in research and development to the expansion of production facilities or even more strategic acquisitions. It's about fueling future growth and staying ahead of the curve.
So they're not just paying down debt. They're also laying the groundwork for continued expansion and innovation. They're not content to just sit back and enjoy the ride. They're in it to win it.
That's one way to put it. They're demonstrating a balanced approach that reflects both financial prudence and bold ambition. They're solidifying their foundation while also preparing for the opportunities and challenges that lie ahead. They're not just playing the game, they're changing the rules.
All right, we've covered SAML's commitment to electric vehicles, their greenfield expansion, their stellar financial performance, the concept of pain sharing, and their recent capital raise. They're a company in perpetual motion, constantly adapting and evolving to maintain their leadership position. But what does their strategy tell us about the broader automotive industry and the challenges other companies are facing in this turbulent landscape?
That's a great question, and one that we'll explore in the final part of our deep dive. Stay tuned.
Welcome back to our deep dive into Samvardhana Motherson International Limited. We've been exploring their impressive performance strategic moves and that all-important bet on electric vehicles. They're really making waves in a rapidly transforming industry.
They are. What's impressive is how they're turning challenges into opportunities. Take the global chip shortage, for example. It's been a major headache for the entire automotive industry.
It certainly has disrupted production lines, delays, and a whole lot of scrambling for those crucial components.
But SAML has used this disruption as a catalyst to strengthen their supply chain relationships. They've deepened their collaboration with chip manufacturers, securing a more stable and reliable supply of these essential components.
So they're turning a crisis into a competitive advantage. Instead of just reacting, they're adapting and evolving their strategies to navigate the storm.
Exactly. And it's a lesson for other companies facing similar challenges. Don't just weather the storm. Use it as an opportunity to reevaluate your strategies, build more resilient systems, and emerge stronger on the other side.
Necessity is the mother of invention, as they say. Now let's step back and look at the bigger picture. SAML seems to be thriving in an industry undergoing a massive transformation. What does their success tell us about the future of the automotive sector?
I think it highlights the paramount importance of agility and adaptability. The old ways of doing business simply won't cut it in this rapidly evolving landscape. Companies need to be nimble, responsive to change, and willing to embrace new technologies if they want to survive, let alone thrive.
SAML is a prime example of that. They're not clinging to the past. They're actively shaping the future with bold moves and a willingness to embrace the unknown.
And their laser focus on electric vehicles is a clear indication of where they see the industry heading. They're placing a big bet that EVs will eventually become the dominant form of transportation, and they're backing that bet with significant investments.
It's not just about the vehicles themselves, though, is it? It's about building an entire ecosystem around electric mobility. The charging infrastructure, the software, the connected services. It's a whole new world.
You're absolutely right. SAML recognizes that the automotive industry is becoming increasingly intertwined with technology, and they're positioning themselves at the forefront of that convergence. They're not just building cars, they're building the future of mobility.
That's a powerful vision. But this transition to electric mobility also raises important questions about the challenges other companies in this space will face. What hurdles do other automakers and suppliers need to overcome to compete in this rapidly evolving landscape?
One major challenge is the sheer scale of investment required for research and development, particularly in areas like battery technology, electric powertrains, and autonomous driving systems. These aren't incremental changes. They demand a fundamental shift in thinking and a willingness to embrace entirely new technologies.
It's not just about tweaking existing designs. It's about reimagining the very concept of a vehicle from the ground up.
Precisely. And that level of innovation requires significant financial resources, technical expertise, and a long-term vision that many companies may struggle to muster.
Not everyone has the deep pockets and risk appetite of a SAML. What other challenges should we be aware of?
Building a robust and reliable supply chain for EV components, particularly batteries, is a critical hurdle. The raw materials needed for battery production are in high demand, and securing a stable and ethical supply is essential for any company hoping to succeed in this space.
So it's not just about building the cars. It's about ensuring a sustainable and responsible source of the materials needed to build them.
Exactly. And doing so in a way that respects human rights and minimizes environmental impact. The transition to electric vehicles can't come at the expense of people or the planet.
Sustainability is paramount. Now, what about the role of governments in all of this? What can they do to support the shift towards electric mobility and accelerate this transition?
Governments play a crucial role in creating a favorable environment for EV adoption. This includes investing in charging infrastructure, providing financial incentives for consumers to purchase electric vehicles, and setting ambitious targets for reducing emissions from the transportation sector.
So it's about creating policies that encourage innovation, make electric vehicles a more attractive option for consumers, and pave the way for a cleaner, more sustainable future.
Exactly. It's also about supporting the development of a skilled workforce that can design, manufacture, and maintain electric vehicles and their associated technologies. This requires investment in education and training programs that equip people with the skills needed to thrive in this new automotive landscape.
It sounds like we're talking about a multifaceted approach that requires industry, government, and consumers to work together to make this happen.
That's exactly right. It's a complex challenge, but one that we must address if we're committed to tackling climate change and creating a more sustainable future.
Well said. A huge thank you to you for guiding us through this fascinating deep dive into Samvardhana Motherson International Limited. We've covered a lot of ground today, from their financial performance to their strategic acquisitions, their laser focus on electric vehicles, and the broader challenges facing the automotive industry as it navigates this pivotal moment.
It's been my pleasure. SAML's journey offers valuable lessons for any company grappling with disruption and seeking to shape a more sustainable future.
For our listeners, we encourage you to continue exploring this topic. SAML's story is a compelling case study in resilience, innovation, and strategic vision. We'll include links to their investor presentation and press release in the show notes. Thanks for joining us on the Deep Dive, and we'll catch you next time for another deep dive into the world of business and technology.